In this section, we will discuss about the asset monitoring and asset management. This is a very important aspect because this ensures that there is an active monitoring of the project, and if there are any course correction that needs to be done by the lender, he can engage with the developer to course correct it. For example, if a project is seeing a slower sales than what was budgeted in the cash flow, the lenders can push the developer to engage a third-party agency to come out with a new launch strategy. The asset management has three important aspects: the technical monitoring, the sales and collection monitoring, and the escrow and financial control. In respect of technical, the monitoring includes the monitoring of the key approvals which has been agreed, the schedule monitoring, whether the construction is happening as per the schedule. As explained, the typical slab cycle of a real estate project varies from 2 slabs a month to 4 slabs a month. The asset monitoring team or an independent third-party project monitoring team will check whether the project construction is happening as per the schedule and the cost is incurred is as per the budget and is in line with the physical status of the project. This is a very important aspect to ensure that the monies are not diverted from the project, because sometimes a lot of cash element is also used for the construction of the project. In terms of the sales monitoring, it is important to analyze the actual sales performance versus what was budgeted. And if any course correction needs to be done, then proactive action should be taken by the lending institution to engage with the developer to appoint third-party sales, or in some cases, we have seen that the sales could even increase by reducing a price by 5 to 10%. Those kind of active interventions are required to be done by the lender to secure their capital. A periodic sales performance review should also be done as a part of the entire asset monitoring process in terms of what is the collection percentage and what is the percentage of money collected vis-a-vis the amount due. For example, if a customer as per the CLP is supposed to pay 80% and the borrower or the developer has collected 60%, the variance should be analyzed and then highlighted to the developer for course correction, such that the CRM team of the developer can follow up with the customer to raise and get the money for the project. As a part of the sales review, it is important to analyze what is the percentage of collection that has happened vis-a-vis the due. If there are any major variances, the customer relationship management team of the developer should follow up with the customer to expedite the collections, because any delay in collection will increase the requirement of the construction finance and can delay the execution of the project as well. Another important aspect of the asset management is to do the financial and escrow management. Escrow reconciliation is the process by which the asset monitoring team or the external vendor reconciles all the collections received in the escrow account and tallies it with the outflows in terms of the project expenses. Typically, the collections is also tallied with the customer-wise breakup of the collections, the customer-wise dues and the amount that has been collected. In respect of the expenses, as mentioned, the asset monitoring team also verifies whether the site progress is in line with the amount which has been spent by the developer on construction. The asset monitoring team also does a periodic review of the asset cover or the cash flow cover, the concept of which was explained to you in the earlier sections. If the cover of the project or the loan has fallen below the stipulated cover, the lender has a right to call for additional security or tell the promoter to pump further money for completion of the project. As explained, the entire asset monitoring can be done either in-house by the asset management team or through an external third-party project monitoring team. As a part of this process, periodic site visit is also done and photographs of the projects are taken on a periodic basis to assess the physical progress of the project. The promoter meetings are also done to analyze any variance in respect of the business plan versus the actual for the sales price, the sales velocity and the construction cost. The repayment of construction finance loan or developer finance is typically structured through escrow mechanism. The repayment schedule is determined and agreed upon by the lender and the borrower depending on the stage of the project and the financial closure of the project. Typically, the construction finance loan is repaid in installments after an agreed moratorium period. What is moratorium period? Typically, this is the period in which no principal payment needs to be done by the developer, and it is a portion of the entire construction finance and the lender. The project cash flows are routed through escrow, and a defined waterfall mechanism ensures the cash flow distribution between the borrower and the lender. In terms of the priority of the cash flows, the waterfall mechanism, the way it works is, first the project related expenses is paid out, then the scheduled interest, the scheduled principal, and then if there is any surplus, then the prepayment of principal happens based on the underlying cash flows. A sweep ratio is typically agreed between the lender and the borrower. Sweep ratio, the percentage of cash flows which will be distributed between the lender and the borrower. In a typical project, at the initial stage of development, the lender typically prescribes a sweep ratio which can vary from 10 to 30% of the project. And as the project goes near completion, the sweep ratio is then increased to 60% to 100%. The control of the sweep ratio is one of the important aspects of the lending business, because this will ensure that the monies are utilized for the purpose for which they are stipulated. Now let's take an example of how the sweep ratio works. For example, if rupees 100 comes in an escrow account, and if the agreed sweep ratio is 10%, then rupees 10 is used for the servicing of the interest and principal, and the 90 rupees is released for project expenses. The construction finance loans are also repaid through other sources as well, through the promoter equity or liquidation of additional security, which is also mortgaged as a part of the loan, or sometimes the loans are also refinanced by the other lenders. Just to summarize the entire process, let's take a walkthrough of a live example. A borrower comes to a CF lender and makes a proposal for a requirement of the CF loan. Once the loan application is received by the lender, as explained, the credit team assesses the viability of the project and prepares a term sheet for negotiation with the lender. The term sheet captures the broad terms of the loan, which includes the end use of the loan, the tenor, the rate of interest, the condition precedent of the loan, and condition subsequent. Once the term sheet is agreed between the lender and the borrower, the lender typically starts the process of taking internal approvals. The process of internal approvals will include the assessment of the business plan given by the borrower, assessment of the underlying project, including the sales and the micro market analysis of the project, the assessment of the creditworthiness of the borrower. Post this, the transaction or the credit assessment memo is prepared, which is then presented to the committee for approvals. The inputs of the committee is also minuted and recorded as a part of the deliberation of the transaction. Once the loan is sanctioned, the CP compliances needs to be done by the borrower, post which disbursement will happen. Typically, the CF loan is disbursed on a tranching basis based on the construction and sales milestone. Once the disbursement is done, it is important and imperative for the lender to manage the investment through an asset management process. The asset management process will include periodic site visits, assessment of the pace of the construction, periodic meetings with the promoter to analyze the actual sales performance with the budget sales, and the approval developments which are happening in the project. The other important part of the asset management is the monitoring of the project cash flows through the escrow mechanism. The priority of the lender and the borrower is always to ensure the project gets completed. Hence, during the initial stage of the project, the majority of the cash flows is used for the project completion, Any surplus after project completion is used for the servicing of the interest, principal and the prepayment of the loan. The construction finance loans are typically closed or repaid from the underlying cash flows of the project. They are sometimes also repaid through takeover by some other lender or from the promoter contribution or liquidation of an additional security of the promoter. In short, this is the process in which a typical construction finance loan works.